Hi everyone, as you are filtering in here, I will do a brief introduction for myself and go over a few housekeeping things so that today can run as smoothly as possible. So first of all, my name is Ellie Moffett. I work for Sales Tax and More, and I'm very grateful to have you here. We hope that you've been to past webinars, and we hope that you are joining us for future webinars, and we'd love to hear feedback of what you think. So let's get started. If you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. The first thing we'll need you to do is answer our poll questions. You should be able to answer those. They'll pop up on your screen. You'll have about 30 seconds to answer them. I'll give you a million annoying reminders that you have to fill those out in order to receive CPE credit. The second thing you'll need to do is fill out the survey at the end of the webinar. There are two ways you can do that. The first way is by filling it out when it pops up on your screen. If for some reason pop-ups are blocked or you don't have time, it will be emailed to you in 24 hours and you can fill it out at that time. You can expect to see your CPE credit in 48 hours or so after you fill out that survey. Another important thing to take note of as we're moving through here, if you have questions, please ask them. We will answer your questions at the end of this webinar or follow up with you via email after. You're welcome to follow up with us with questions about our services after the email, but we do want to answer your questions during this webinar. We'll also be sending out the slides. We'll be linking those in the chat box. That's where you can also find today's handouts. If you're not seeing them, please send me a message. I'll try to make sure that you can get your hands on those. So let me do a quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax or related needs. So we do a lot of returns, registrations, consultations, research, and like our name states, more. So if you have questions about our services, please reach out and ask. We'd love to answer those questions for you. And a quick introduction too for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded. He's one of the United States leading authorities when it comes to e-commerce, Nexus, service providers, and drop shipping. Over the years, he's literally assisted thousands of sellers, both foreign and domestic, with their tax issues in the United States and Canada. So Mike, if you want to take it from here, let's get started.
Well, thanks, Ellie. Wonderful introduction, and welcome everyone. Thank you for taking time out this morning or this afternoon, depending on where you're located, to join us on a Friday. Before we get started, actually in this webinar, this is actually part of the update, but we want to talk about COVID-19 and the crisis that we've been having. So, I'd like to start out by saying I hope everyone is staying safe and healthy and being as prosperous as we can be in these times, and being positive. I know we're starting to open up the economy right now. We've been telling people that we, speak to both internally and externally that, we want to keep a positive mental attitude. We'll all get through this. Some people don't handle this as well, and sometimes they, we had the doctor in New York who actually committed suicide. I had someone in my family who tried to commit suicide. So not everybody handles this as well as everyone else. So it's important that, we all try to be leaders and be positive with our, fellow employees, with our families, with our neighbors. Very trying times, and some of us deal with it better than others. The second thing is, with the country starting to open up again, it's still, it depends on who you listen to, but it can still be pretty dangerous. So like here in Texas, our numbers of new cases are peaking making new highs every day. As are the number of deaths we're experiencing. So even though we are opening back up, it still looks like we've got an issue here. So be safe, be smart, stay healthy. I'm going to be wearing my mask every time I do go out in public and still following the social distancing rules. When it comes to taxes, we have created a website here And, you know, a lot of states are putting off the due dates. And some states like California, Governor Newsom has come out and said that you know, you can have a year to pay these taxes. Basically, give yourself a tax-free, an interest-free loan. And I think his heart's in the best place. But you know, we have a blog post here that says not all extensions are created equal, and you know, letting people think that they can use sales tax to fund their businesses is pretty scary. And the reason why is sales tax is generally not a good source of funds because it's generally not your client's money or it's not your money. It's either the state's money or the customer's money. And the retailer or the person making the sales, they're just collecting it in trust for the state. So there can be criminal penalties up to and including jail time for tax collected, not remitted. And there's personal responsibility, which means that, you know, you can bankrupt your business. You can even do a personal bankruptcy, and this generally survives both and it follows you. So, you know, unless Governor Newsom is going to be waiving the personal responsibility, unless he's going to be waiving these criminal penalties, you know, California's thought process right now, I've read this in a number of news articles, is that they're just, you know, going to get their tax money late and, you know, they're foregoing the penalty and interest on it. Unfortunately, not all businesses are going to make it through these times. There's been so much damage done. Some of them just won't make it. And, you know, we've got to let our clients know. We've got to let, you know, the people within our own companies know, as bad as things can get, using sales tax to fund the business can be disastrous, because, you know, if you use credit cards to fund your business, and in the worst case scenario, the business goes under, you walk away from them. You know, maybe you have to file bankruptcy. You can use income tax money that you were going to pay your income taxes with. Yeah, the states may not be happy. They'll slap you on the wrist, but income tax is your money. Sales tax is not. So we've got to make the distinctions. You know, I understand that some businesses out there are doing so poorly that they may, you know, think about this. If you do, I just hope that you have it by the due date, because tax collected, not remitted is nothing to fool around about. Some states are actually saying this. In Maine actually sent out a letter the other day. It was actually an email, and the highlighted sections here, you know, really summarize what I've been saying. Unlike income tax, sales tax and state withholding tax are trust fund taxes held in trust. And the next line says, Maine law prohibits taxpayers from using these trust funds for their own purpose. So pretty much every state says something similar. And a lot of them have been reminding us. The reason why they're giving us extensions on the sales tax side is not so that we can use that money to fund our businesses. For the most part, most states are doing it because they realize there's been a disruption and you may have trouble getting to your data. Maybe your accountant who does your taxes is, you know, shut down. Maybe, you know, people from home can't access the data from the work servers. So there's lots of reasons, and that's the primary reason why the states are you know, extending due dates. But generally, it's not so that you can use that money to fund your business. To me, that's a very dangerous situation. All right, so if anyone has any questions about that, you know, go ahead and ask them, and we can follow up with you offline. Today, we're going to cover, you know, a Nexus definition. We're going to talk about some court cases real quickly. We're going to go into economic nexus, what the new trends are. We're going to talk about physical nexus. I think that this is getting overlooked at this point, and it's probably more important now than ever, especially if you are selling online. Marketplace collections, you know, it's looking very, very bright if all you do is sell on marketplaces. We'll talk about that. Deregistrations and, not worrying about sales tax is something that we're going to talk about there. We're going to give our opinions, or my opinion of the future. We're going to talk about California a little bit, and then what to do if you or your clients do have Nexus. I do a lot of looking around. I got 3 screens here, my head's on a swivel. So once we get started, I'm going to turn this camera off. I'm going to open it back up when we get to the questions at the end, but I don't want to subject you to all of my body movements here. As we're going through this, remember that the worst time to find out that you have problems or that your client has problems is when the state's knocking on the door. Either, they want to audit you, or they're sending you a Nexus questionnaire. At that point, you don't have very many options at all. If you're being proactive before state contacts you, there are a number of options that you have to help reduce your exposure. But once the state knocks on the door, those options are limited. All right, Ellie, do we want to go to the first poll question?
Absolutely, that should be up on everybody's screen right now. We'll give you about 20 seconds to answer this. We want to know how you would rate your Nexus knowledge. So just to get some idea of who's in the crowd today, Mike, it looks like we have a really good mix. We absolute beginners to an expert, a couple experts in the crowd. So we're going to close this out in just a second and we can move on.
Great. Those experts can keep me honest. Those Nexus experts. All right. So we're going to start off with a brief definition. And Nexus is just a fancy way to say link or connection. And it's the link or connection that must be present before a state can require you to collect its taxes, like a sales tax or a seller's use tax, or pay its taxes like an income tax, a franchise tax, consumer's use tax. Up until the Wayfair case, at least for sales tax, there had to be some sort of physical component. We can all argue as to what does create a physical link or connection, but there had to be something there. But as of the Wayfair case, no longer a requirement to have a physical component as this link or connection. And we say that it all starts with Nexus, because if you don't have Nexus, then the state can't require you to collect its tax or pay its tax. So no Nexus, no link with the state means no problems, no further responsibility. Now, it's not the end of the world if you do have Nexus. It just means you need to start looking at a couple of other things. Or if your client has Nexus, they just need to start looking at a couple other things. But if you don't have Nexus, no problems, no responsibility. I do want to talk about a couple court cases very briefly. We're not going to get into too much detail. These are all U.S. Supreme Court cases, and I think they're important to the conversation. The first one here is National Geographic versus Board of Equalization. Started out in California, went to the Supreme Court, and the takeaway here is that the taxable activity does not have to relate to the Nexus creating activity. And what this really means is that once an entity has Nexus, it doesn't matter what business channel we're talking about. If it's a taxable sale, then the state expects you to collect and remit the tax or a certificate in lieu of the tax. I'll give you an example, and this one comes up all of the time. We've got a company, maybe they've been doing a wholesale business, or a manufacturer, maybe they've been selling to just, distributors. And now they decide they want to go directly to the public. So they start selling online. But they, have a great big network of manufacturers reps or salespeople or independent contractors all across the country on the wholesale side of the business. And when they start selling online, they don't realize that it's not looked at as a separate business. It's all one entity. And these wholesale reps, these independent contractors, these manufacturers reps do create Nexus for the wholesale company. Now, the wholesale company may not care because, they don't collect tax. But now from day number one, from your first sale, you may have a responsibility to collect the sales tax on these online sales because of the concepts that come out of this case. Taxable activity does not have to relate to the nexus creating activity. So the wholesale activity in this case is the nexus creating activity, and the taxable activity are the online sales. And we could go through a whole bunch more examples, but we'll leave it there for now. I think that the next case, Tyler Pipe versus Washington Department of Revenue, this is perhaps one of the most important cases when we talk about nexus, especially when we talk about physical nexus. This is a follow-up to the Scripto case from 1960. Both of these cases have to do with third parties. And this one's really important because what the U.S. Supreme Court said here was that third parties who establish or maintain a marketplace can create nexus. And the reason why this is so important is that language, establish or maintain a marketplace, so many of the states picked it up and they incorporated it directly into their statutes or their rules, their regulations, or they use it to provide guidance. The New York State click-through nexus was based upon Tyler Pipe. In Tyler Pipe, you had, one independent contractor up in the state of Washington, and Tyler Pipe was a Texas company, and the state of Washington said, hey, according to the Scripto doctrine, you should be, paying our business and occupation tax. And Tyler Pipe said, oh no, this isn't like that at all. This person, they don't represent us exclusively. They represent a whole bunch of companies out there. They're not very good at their job. They do it on a part-time basis. And the court unfortunately came back and said, paraphrasing the first part here, it doesn't matter what you call someone, doesn't matter how you pay them, doesn't matter if they represent you exclusively or multiple parties out there. Doesn't matter if you call them an independent contractor, a subcontractor, or just if you're entering into an agreement with a company. Doesn't matter if they do it on a full-time or part-time basis. Here's what's important. Are they helping you to establish or maintain a marketplace? So we're going to come back to this one because it's very, very important. Complete auto transit, a lot of times, especially if we have, Amazon sellers online here, they start saying, well, only Congress can control, the taxation of interstate commerce. If we're going back 90 years or so, they're absolutely 100% right. Even the states believed that you couldn't tax interstate commerce back then. That all started changing in the 50s, and, there are a couple of Supreme Court cases that chipped away at that until we get this complete auto transit in 1977. And at that point, the Supreme Court didn't really come up with anything new. They just cobbled together all of these other cases, and they said, yes, a state can tax interstate commerce directly as long as it meets a four-pronged test. And it's a pretty easy test to meet. So since 1977, states do have the right to tax interstate commerce directly. All right, and then we have South Dakota versus Wayfair. This is the case that happened in June of 2018. And what it did is overturn the two cases, Quill Corp and National Bellis Hess, that had to do with physical presence. And the Supreme Court didn't say, hey, things have changed, so we need to relook at this. What the Supreme Court said is we made a mistake. We never should have introduced the concept of physical presence to begin with. And it's like these cases never happened because they've been overturned. So in theory, states could go back all the way to 1967 in this National Bellis Hess case. Now, South Carolina was pretty smart. They knew the Supreme Court was going to be worried about that. So they said that we're only going to do this on a prospective basis. And what they were going to do is enforce economic nexus. And, a nexus means link or connection. So the link or connection is based on either sales or transactions. That's enough to create a link with the state and a requirement to collect and remit tax. So The Supreme Court looked at South Dakota's $100,000 or 200 transactions. They didn't explicitly say that, you know, hey, this sounds good, but implicitly they sort of said, hey, it makes sense. They did send it back to the lower court so they could decide on the issue, but the lower court case was settled prior to them getting this worked out. So we may see more litigation on this going forward, but the states are getting very aggressive in pursuing companies. So I would not wait for the results of any lawsuit. And believe it or not, I have some people saying, you know, well, we're not doing anything until this gets worked out in the courts or Congress steps in. Good luck holding your breath on either one of those two things. It's, you know, unfortunately, it looks like this economic nexus is here to stay. It may change a little, but how much exposure or liability are you going to incur, or your clients going to incur while you're waiting for a Hail Mary? I just don't think that it's very realistic at this point. And it's a lot cheaper to do what the state says than to fight the state at some point down the road. All right, so when we're talking about economic nexus, everyone says, well, our wholesale sales included, our resale sales included, our marketplace sales included. Is this based on total sales, or is it based on, you know, just certain types of sales? And the answer to all of that is yes, or it depends. Each state looks at it very differently. So some states say exempt sales are included, but sales for resale are excluded. So it's very, very particular. This is really important too. I get this all of the time where someone calls me up, you know, an existing client even, and says, Mike, I want to deregister in these 3, 4, 5 states. I say, okay, how come? And they say, well, because we're underneath the thresholds. And I say, well, we didn't get registered there because of the thresholds. You know, or you had salespeople there, or you had other types of employees there, or whatever the reason is. I ask them, is that still the case? And they say, oh yeah, no, none of that's changed. We still have all those people there, but now we're under the thresholds, so we can deregister. And unfortunately, it doesn't work that way. These thresholds, this economic nexus, is never meant to protect you. It's just one more way that the state can require you to do what it wants you to do, which is collect its taxes. It's never going to override physical presence. As a matter of fact, physical presence will always override economic thresholds. So it's real important to remember that. Second thing important to remember, this is not an internet issue. Even today, you know, 2 years later, I'm speaking to some very smart people out there, and they refer to this as an internet tax. And it's, you know, it's really not an internet issue at all. It's a multi-state issue. You can have a client, or you could be selling by telephone. You know, you don't do anything on the internet. If you're selling into multiple states, this can impact you. If you can do it by referral, you can do it by infomercial, you can do it by catalog. You know, it doesn't matter how you're selling. It has nothing to do with the internet. If you're selling into multiple states, then you can be impacted by economic nexus. All right, so only 2 states don't have some sort of threshold at this point. That's Florida. It looked like, you know, before we had the shutdowns due to the crisis here, that the legislation was going to send to the governor, the legislatures were going to send some legislation to the governors that said it's $100,000 or 200 transactions. The governor said, we don't need any new taxes in Florida. I don't think the governor in Florida knows or understands sales tax very well, because these are not new taxes. It's just who's responsible for collecting the taxes or paying the taxes. But he said he was going to veto it. It looked like the legislators had enough votes to overturn the veto, but we just don't know where they are at this point. Missouri looks like it will pass. Everyone was on board, including the governor. It had an effective date of 10/1/2020. Don't know where that is now because of the crisis. So we'll keep you updated. we do have a chart on our website, and Ellie's going to give it out for free where we track all of these things. And every time a state does say something, then we update it. But in Kansas, the governor vetoed the legislation twice because it was linked to a tax cut for groceries. And the governor in Kansas say, hey, we need every tax dollar. We're hurting. We can't afford to, cut taxes at this time. So it didn't pass. And the Department of Revenue came out and said, well, Supreme Court said we don't need a physical presence. We don't have the ability to do a threshold. So we're just going to say if you got one sale in the state of Kansas, then you've got economic nexus. And a lot of our competitors are still saying that out there. A lot of the software companies are still saying that. Unfortunately, they're wrong. The Attorney General in Kansas came out about 10 days after the Department of Revenue came out. And the Attorney General said, nope, Department of Revenue, you cannot do that. You have to at least use the safe harbor protections of the Wayfair case. So that's $100,000 or 200 transactions. We recommend to our clients that if you are over one of these thresholds and your exposure is material, then you should go ahead and get registered at this time. All right, so here's the chart that I was saying that Ellie's going to get you. It's also on the website. It'll tell you the effective date of the when the state went live. It'll tell you what the monetary threshold is. It'll tell you if there's a transaction threshold, and if there is, what that is. It's going to tell you the calculation methodology. There are 3 of them. Some states look at the previous 12 months, preceding the month in general. Other states say previous calendar year, and some states say previous calendar year or current calendar year. It's those ones are the most confusing and the ones that you've got to stay on top of. All of them you need to stay on top of, but those ones, take people by surprise sometimes. If you have a really good current year, then you can get over some of these thresholds very quickly, even if you weren't over it last year. All right, is registration required for out-of-state sellers if only selling through a marketplace? In most states, the answer is going to be no. So that's why we're talking about deregistrations if you're only selling on a marketplace. If you're selling on a marketplace and another channel like your own website, and by the way, Shopify and BigCommerce and WooCommerce, those are all considered your own website. Then you can't talk about deregistrations. So this is a great tool here. I suggest that you go through it. What's included or excluded from the threshold calculation. That is 1, 2, 3, 4, 5, 6 column over. Lots of great information in that column. It'll tell you how you calculate that threshold. All right, so something we were seeing, trend away from transactions. The states of California, Colorado, Iowa, North Dakota, and Washington originally had transaction thresholds. But they said, you know what, that doesn't seem very fair. So we are going to eliminate the transaction thresholds. So Washington was one of the first states to adopt an economic nexus threshold. They were at $100,000 or 200 transactions. Now they're just at $100,000. So we're starting to see a trend away from transactions. The states in the next group there, they never had any transaction thresholds. So when they came out, like the state of Texas, they just said, $500,000, no transactions. And then Connecticut and New York, they have no standalone transactions. All these other states that do have transaction thresholds say $100,000 or 200 transactions. States of Connecticut and New York say $100,000 and 200 transactions. State of New York says $500,000 and 100 transactions. So no standalone transactions. Now, just because there's a trend away from transactions doesn't mean that you don't have to pay attention. A lot of states still have transaction thresholds. and the states are enforcing them. And if we look at the two states that don't have economic nexus yet, Missouri's coming out, and looks like theirs will not have any transaction thresholds, but it looks like Florida will have transaction thresholds. So even though there's a trend away from it, we still have to pay attention to it. All right, so this is really important. You know, South Dakota was really smart. They said, we're only going to do this prospectively, but that's prospectively from the effective date. And some of these effective dates are getting very old, and the states are starting to get very aggressive. You know, state like Maine, we have some clients come to us and say, hey, you know, Mike, we just realized we need to get registered. We understand we should get registered as of July 1st, 2018, but we just want to get registered going forward. And I got to tell them, you can't do that because the state of Maine is auditing everybody. And they're making them pay back taxes, penalty and interest all the way back to July 1st of 2018, unless you can prove you didn't have Nexus. So we're fighting some. A lot of our clients, you know, didn't have Nexus all the way back then. So we're, you know, we call them mini audits. They're not a full-blown audit, but they're still, you know, getting audited. Other states like South Dakota, they're going to stop you during the registration process and say, prove to me you didn't have Nexus as of November 1st, 2018. Otherwise, we are going to make you pay all the back tax, penalty, and interest. States like Utah are, they purchased a list of people they think are over their thresholds and have started calling them. Wisconsin is starting to questioning people. South Carolina is questioning people if you're doing the remote seller registration. If you're doing the normal registration, they are not questioning people. So we expect the states, all of them, to be getting a lot more aggressive here. And we started seeing a lot of these states begin to do that before this crisis. They've backed off during the crisis. But as soon as, you know, we get past talking about, you know, the disease itself, this virus itself, we think these states are going to, you know, they got to make up for lost time. These states are hurting for money. We think they're going to be coming hard, and they're going to find all sorts of other nexus while they're coming. So don't procrastinate here. I mean, you know, don't let your clients wait because with every day, you know, this is beginning to build. You know, we're coming up on, heck, this June will be 2 years for some of the states, June 30th. So that's a lot of potential exposure there. All right, so not every threshold is economic nexus. We've got to look at cookie nexus. We've got to look at click-through affiliate nexus, and we got to look at notice and reporting requirements. So cookie nexus is actually viewed as a type of physical presence, or at least by the states that were using this. And it's when, you know, a company installs data packets on in-state computers. And the reason why, their rationale behind this is because once that cookie's there, it's used to do all sorts of advertising and tracking and everything else. I mean, you see pop-ups. You ever wonder why, so, you know, once you get on someone's website, it follows you everywhere? Well, that's because of these cookies. And, you know, Massachusetts was perhaps the most aggressive. They said, if you install cookies on someone's computer and you have $500,000 in sales and 100 transactions, and that was a physical nexus, and they're coming after you. Now, that date was October 1st of 2017. And Massachusetts is still pursuing some companies for that. So just because they have economic nexus, which phased out this cookie nexus, doesn't mean companies that are in the state's pipeline that they already know about are scot-free. All right, so click-through nexus. And we said that, you know, New York was the first one to do this. They did it back in 2008. They based it upon Tyler Pipe. They said, you know what, if one independent contractor can create an issue for Tyler Pipe, then why in the world does a whole state full of people that are steering business to Amazon, is that not worse? I mean, they're all getting paid a commission. You know, they're being paid for specific performance. If nothing closes, they don't get paid at all. You know, is that, you know, a, a better idea than just one independent contractor? And the highest court in the state of New York said, yeah, it makes sense. It never made it to the U.S. Supreme Court. They tried to send it there, and U.S. Supreme Court did not grant cert. And, you know, after New York, you had a bunch of states jump on board. And at the highlight, there were, you know, 21 states or so. And the thresholds, you know, were between $2,000 and, you know, $500,000. You know, there are thresholds here, but this is still considered a type of physical presence. It's like having an independent contractor in the state. So that's how you know, these states, you know, can go back, you know, how 2008, some of them, you know, that's 12 years. So we've got to look out for this. A lot of states are getting rid of this now that they have economic nexus, but some states still have it on the books. All right, notice in reporting, this is perhaps one of the most heinous things I've ever seen states do. Colorado started this, and this was back in 2010, and they said, you know, we don't have an Amazon warehouse here, but we certainly want a piece of their online revenue. So we can't force people to pay their taxes. They don't have this link or connection with the state. There's no nexus here. But what we can do is make their lives so darn miserable, they're going to say, hey, I'd like to register voluntarily. And once they registered voluntarily, they didn't have to worry about this. And a number of states jumped on board with this. And what it means is that you got to send out a series of 3 or 4 notices, depending on the state. Some of them you had to have something up on your website also that says, hey, you know, Mr. Customer or potential customer, we're not registered to collect the tax in your state, so you must self-assess and remit that to the state yourself. And oh, by the way, at the end of the year, we've got to turn in a list of our customers to the state with all the purchases. So at best, you know, this is horrible messaging to your clients. What your clients are hearing is, you mean you're not doing what you're supposed to do, so I got to do all of this stuff, and you're on top of that, you're going to tell on me, you're going to tattle on me to the states. So not great marketing. But what makes it worse, there were very low thresholds, and the penalties were draconian. I mean, so much worse than sales tax. So, you know, in a state like Oklahoma, if you were over $10,000, Oklahoma says that the penalty is going to be based per instance, and there could be 3 or 4 instances per transaction, and you're going to pay the lesser of 20% of your last year's sales into the state of Oklahoma, or $20,000. So if you've got $10,000 in sales, that could be 400 or 500 different transactions. It could be, you know, 3 times each of that. You could have 1,500. And if we're talking about 20% of $10,000, that's $2,000. We're at, you know, $300,000 very, very quickly. So on $10,000 in sales, I mean, this is ludicrous. Now, most of these notice and reporting have been sunset since economic nexus has come along. However, Vermont and Puerto Rico, they don't have any thresholds. We still got to worry about them. Not so much about Vermont, because Vermont is very, very low penalties. It's like $25. You know, so you may have, you know, a couple $100 rather than a couple $100,000. But they're still active. We got to look at those. You got to look at Oklahoma. A lot of people out there saying, oh no, Oklahoma got sunset. It didn't. You know, you've got economic nexus at $100,000. So you have the option between 10,000 and 100,000 to either do the notice and reporting or get registered. Once you hit 100,000, you have to get registered, but Oklahoma is still live. That skips a lot of people, so you got to worry about that. And then Louisiana is still alive, and they are enforcing that. Here's a list, another chart. As I said, most of these states have either sunsetted or there's no penalties involved. So if there's no penalties, then to me, that's just a suggestion. And Ellie's going to get that out to you, and it is up on our website. Now, a couple of developing trends. We've already touched on these. Number of states, but not all, are moving away from the transaction thresholds. Some, but not all, are eliminating their click-through or Nexus as they're implementing economic Nexus. And then some states are eliminating notice and reporting requirements, but you got to look out for Louisiana, Oklahoma, and Puerto Rico, and to a lesser degree, Vermont. All right, Ellie, let's go to the next poll question.
That should be up on everyone's screen right now. We just have a quick true or false question. You must have physical presence to create Nexus. Mike, most people are answering false here. We're going to leave this open for about 10 more seconds while answers are still rolling in, and then we will close it out and move on.
Okay. All right, so let's talk about some types of physical presence. We're not going to go too deep into this because a lot of e-commerce sellers don't have it. Some of you do, or some of your clients may have it. And we do a whole webinar on physical presence Nexus. Some of the big ones are third-party Nexus. This is what we were talking about earlier in the Tyler Pipe case. Activities of third parties can create Nexus if they're helping to establish or maintain a marketplace. While that particular case and the prior case of Scripto both involved sales or solicitation, since that time, this has really become umbrella language. And this is not an all-exhaustive list or all-inclusive list, but all of these are examples of what can create Nexus. What we usually tell our clients is if someone is traveling into a state on your behalf, or if they're interacting with the public and your customer can be considered the public, then there's a good chance that's going to be a Nexus creating activity. If it's someone who's doing work behind the scenes, like an accountant, or maybe you hire someone to develop software for you, they're generally not going to be interacting with the public. They're generally not traveling into the state, and therefore they're not helping to establish or maintain a marketplace. While the states are coming and looking for economic Nexus, they're going to stumble across all sorts of Nexus types. And this is one of the ones that is going to catch most companies off guard, because it doesn't make sense. How can a third party, someone who doesn't even, work for you, you can't control their hours or how they're doing the job or anything else. But unfortunately, yes, they can create Nexus. All right, another one is travel. It's not just where your employees or contractors live, but anywhere they travel on your behalf. So those are two that I want to point out. The third one, and this is especially true of e-commerce companies. I speak to so many people a month who tell me, well, Mike, I don't have a location anywhere. Everything's in the cloud. Unfortunately, we're talking about links or connections, and the states take the position where you live or operate your business from is a link or a connection with that state. So you don't live in the cloud. Your business may live in the cloud, but you do not live in the cloud. So that catches many, many companies off guard. All right, so Ellie, let's go to the next poll question.
We want to know what about sales tax Nexus concerns you the most. We'll leave this open in about 20 seconds. Again, quick reminder, you do have to fill this out in order to receive CPE credit. This will probably be our last poll question of the day. And as these questions are still rolling in, we'll leave this open mic. So 5-10 more seconds as you guys are still answering. Like a lot of people concerned about economic nexus and third parties. And let's close this out and move on.
All right, that's generally what we see. Those are two big ones. All right, so let's start talking about marketplace facilitators. So marketplace facilitator is someone like an Amazon, an eBay, an Etsy, a Walmart.com. They're not platforms like Shopify, BigCommerce, WooCommerce, etc. As of now, Ellie, we need to update this. There's 43 states that have collection requirements. Not all of them are active. For example, Tennessee had their legislature working during this shutdown crisis, and they have passed legislation, and beginning October 1st, Tennessee is going to require Amazon and other marketplace facilitators to start collecting. So there are 43 states that at this point have said something. And by the way, for those of you who don't know, Alaska has an economic nexus. It's $100,000 or 200 transactions. And while they don't have a state level tax, all of the local jurisdictions have banded together, and the Alaska Municipal League is collecting on behalf of all of those jurisdictions. Amazon actually began collecting on behalf of third-party sellers in Alaska. But if you're on your own website or these other platforms, you got to worry about Alaska. So there are 46 states plus Washington, D.C. at this point, where you could have collection responsibilities. And we need to, Georgia started collecting last month on 4/1. So we need to update the language on the last one. That's a little bit outdated. North Carolina actually began collecting on February 1st. All right, so we need to start talking or thinking about deregistrations. If you've been registered and have been compliant and collecting, because you have Amazon inventory, it's time to start deregistering. Or if you've never registered, don't worry about it unless the state comes after you, for past sales. But here's some things that you want to not deregister. For example, your home state. You'd probably want to stay registered in your home state. Washington, because of the business and occupation tax. That's a second tax. It's on the sales tax form, but marketplaces are not going to pay that for you. So Washington's very aggressive. So therefore, probably want to stay registered in Washington. States like California, where if you're shipping, your inventory there, your vendor may require a California resale certificate. And a California resale certificate is only effective if you're registered in California. It's one of the 10 tough states. Connecticut, if you're over $250,000 in sales, they say that you need to stay registered. But by and large, most states, if you're only selling on a marketplace, then you can get deregistered. Hawaii, their general excise tax, they do things a little bit differently. It's actually imposed on the seller. It can be passed through the customer. Right now, the way Hawaii is doing it is saying the marketplace facilitator pays the retail rate of 4%, and the marketplace seller is supposed to still pay the wholesale rate of 0.5%. But the marketplace seller now loses the ability to reimburse themselves. Amazon's not going to pay them that money. So, most of our clients, number one, their sales aren't very material in Hawaii. So a lot of them are just choosing to get registered. The rate is extremely low, and it's not really fair what Hawaii is doing. Illinois, another one, not very fair. If you have inventory in an Amazon warehouse, you're supposed to be collecting the retailer's occupation tax versus the retailer's use tax. Unfortunately, Illinois, in their infinite wisdom, this is an example of how smart states are. They ignored the fact that Amazon is supposed to pay retailers' occupation tax. So they passed this statute that says all marketplaces need to collect and remit the use tax. So now the state is saying, well, Amazon's paying the retailer's occupation tax, and we have no way to tie these two together. So you, Mr. Seller, are responsible for 100% of the use tax. I don't think they're ever going to be able to make that fly. Amazon, in its part, is not doing anything to help out, or they haven't at this point. So basically, the tax is being paid twice, and they want you to be the one paying it twice. And you don't have the ability to collect it from your customer because Amazon's doing that and turning it in. So hopefully July 1st, when everyone is supposed to be paying the retailer's occupation tax, they'll get this straightened out. But as of now, it's an issue. Most of our clients are ignoring this. As I said, I don't think that the states can make this stick. All right, so here's some deregistration warnings. Deregistration is a process that varies between the states. You just can't stop filing. We've had people call us and say, hey, you know, I don't have a responsibility to collect and file anymore. And the state's sending me all of these notices saying I owe all of this money. Yeah, that's what's going to continue to happen until you actually go through the deregistration process. The state is going to continue to pursue you for returns and money. Second thing, income tax, totally separate from sales tax. It has its own Nexus rules. So, you know, if you had a responsibility to pay income tax or franchise tax, just because you deregister for sales tax, it has no impact on those income tax requirements. They are still there. All right, so here's another chart. This chart here is everywhere that the marketplaces are collecting. It's updated on our website and, you know, tell you what the effective dates are. So great tool to have. Let's take a look at what the future holds. I think we're going to see a dichotomy here. I think the future looks very bright for marketplace only sellers. As I've been saying, if you're only selling on a marketplace, you can either not worry about sales tax on a going forward basis, or you can actually deregister. But I think it's going to be ugly for everyone else who's not compliant. States are going to be out there looking for economic nexus. They already started. They had already geared up. This crisis has put that on hold. And historically speaking, whenever we're coming out of a recession, states generally step up their collection activities, their discovery activities, their auditing activities, because they need to make up for lost time. And you're seeing states, you're coming out with staggering numbers. We're $45 billion in the hole. They have to get out of the hole. They're not like the US government, which can print money. The states can't do that. And they have a lot of citizens that need money. And they don't have the money to provide the services that these citizens need because of how bad the economy is. So states are going to be looking for economic nexus. They're going to stumble across everything. The states are going to make examples of companies. And then income tax or similar taxes, I think, are going to become a much bigger issue as we go forward. All right, so that's my view of the future. Let's talk about California real quick. In my conversations with California, again, this is prior to the crisis, they had said they were going to start turning over everyone who's been getting these letters and ignoring them. They were going to start turning them over to audit. And audit is going to do an estimated audit. In other words, they just make up the numbers, and then they'll give you like 30 days to pay. And if you don't, then they turn it over to collections. I think this is going to be quite a shock to a lot of people out there. A lot of people, you know, still expect there to be, you know, a lawsuit that turns out in their favor. And maybe it does, but in the meantime, California is going to be putting down the hammer. At this point, even if you get selected for audit, there's really only one way to limit your exposure. You can't do a VDA, voluntary disclosure agreement, because they've contacted you already. But you can do a managed audit. And in a managed audit, it's where someone like us, a third party, comes in and does an audit for the state or under the state's supervision. And because the state doesn't have to spend the money and the time auditing you, generally 50% of the interest is going to be waived. And if you've had inventory since 2012, sometimes that interest can really add up, and the penalty can be waived. So if anyone needs help, if California is putting the screws to them, then this California managed audit is one of the ways to go. And that is something we can help with if you need help. All right, Ellie, let's open it up to questions.
Mike, we actually don't have any questions today. Is there anything else you would like to go over?
Yeah, let's talk about some common myths. So registering for sales tax creates income tax nexus. And we touched on this a little bit, but sales tax nexus has nothing to do with income tax nexus. Just because you register for sales tax doesn't mean that you automatically have income tax nexus. It does make you more visible to the state, but if you're only registering because of economic nexus, then there's a federal law out there. It's called Public Law 86-272, or the Interstate Income Act of 1959. And what that does is prohibit a state from imposing a net income tax on you if your only activity in the state is the sale of tangible personal property, and the orders are fulfilled from a point outside the state, and they're also approved from a point outside the state. So in a lot of states, if all they have is a net income tax, and only reason you have this link or connection with the state is because of your sales, then the state can't impose a net income tax on you. So for a number of reasons, registering for sales tax does not create income tax nexus. I've heard a lot of people say sales tax registrations require a Secretary of State registration, and that's just a myth also. The states make it look that way, and if you're doing your own registrations, trying to do them online, the states make it a little bit tough because they all make it look like you have to do that, but every state has a workaround. You can call the state up and say, hey, we don't need to be registered with the Secretary of State. What's the remote seller option here? And they'll tell you. Even if you are registering because of physical presence, a lot of times you still don't need a Secretary of State registration. It depends on what your physical presence is. So sales tax registrations require Secretary of State registration. That's just a myth. Wayfair creates income tax requirements everywhere. That goes back to number one. No, it doesn't. As a matter of fact, in most instances, it will not create an income tax requirement. Now, you have states like Oregon. Oregon, has a net income tax, and they said, you know what, we don't have a sales tax. It's going to be too tough to pass a sales tax, and that'll impact, our in-state companies too. What we're going to do is put in a gross receipts tax, and a gross receipts tax, like Texas has one, Washington has one, Ohio has one, Nevada has one. These taxes are not protected by Public Law 86-272. So you may see more states come out with gross receipts taxes, but until they do, Wayfair doesn't create income tax requirements. If you're only getting registered because of Wayfair, then you don't have an income tax requirement in states that actually have a net income tax. If there's a gross receipts tax, like Oregon, Washington, Texas, Ohio, Nevada, then you do have to worry about it. And the next one is I need to register everywhere I have Nexus. And that's not true. I mean, we're talking about deregistrations. Someone may have the responsibility to remit that tax and not you. So that's one reason. Number two, maybe what you sell is not taxable. And in a lot of states, if you don't have any taxable sales, there's no need to be registered. So Nexus is where it all starts, but it doesn't have to end there. I mean, it just means you got to do a couple of things. If your client has Nexus, is what they sell taxable? Is are the numbers material? And are they the ones who are actually responsible for collecting and remitting the tax? And if all those things are true, then you need to register. Otherwise, most instances, then you don't need to register. All right, Ellie, those are my myths.
Thank you so much, Mike, and thank you everyone for attending today. We really appreciate you coming to our webinars. Please leave us your honest feedback. We want to hear it, and we want to give you CPE credit if that's what you're here for. Mike, is there anything else you want to add in before we close out here?
Nope. I just want to thank everyone for coming. Enjoy the weekend. Stay safe, healthy, stay positive, and share the positivity. Those are the things that I think are really important. And staying safe, especially as we all start, each state starts opening up a little bit here.
All right. Thank you, everyone. Have a great afternoon and a safe weekend.
Thank you, everyone. Bye-bye.